This week, the tape was all about risk-off. A hawkish Fed pivot, a major technical breakdown, that was the story. Let's get into the day-by-day of what moved price and why.
All right, let's look at the numbers. They tell the whole story. Equities down, volatility up, dollar firm. It's a classic signature of a market that's de-risking, plain and simple.
So if you had to boil it down to one thing, what was it? Simple. The market completely took a December rate cut off the table. That fundamental shift, paired with the technical break we saw, that was the entire narrative.
Okay, let's get into the chronological tape. We're going to walk through this day by day to see exactly how this whole thing played out.
So Monday, the week kicks off with some really conflicting data, and that put the Fed in a tough spot and, left the market waiting for a clear signal.
You had a hot 4.1% GDP forecast from the Atlanta Fed screaming economic strength. But then, on the flip side, weak jobs numbers and consumer sentiment were pointing to a slowdown. This whole conflict just cemented that higher-for-longer narrative. And of course, that favors megacaps with strong balance sheets. Separately, Zymeworks had its own story, popping on some positive trial news.
All right, Tuesday. This is when the technicals really started to break down.
The signals here were flashing red. The big one? The S&P 500 closed below its 50-day moving average for the first time in 6 months. That's a huge change in market character. On top of that, you had a 25-to-1 insider sell-to-buy ratio and multiple Hindenburg omen signals firing. The bearish case was building. The only thing pushing back, hedge funds were positioned extremely short, which, always brings the potential for a squeeze.
Wednesday, the market basically took a breather.
There were no real catalysts, no data to move the needle, so price action was just consolidative. The market was waiting. We don't invent a narrative when the data isn't there. Come Thursday, the conversation shifted. It wasn't just about the initial break anymore. It was about the deteriorating structure of the market itself.
So, technicians were all over the potential head and shoulders topping patterns showing up in key sectors. Think financials and semis. Momentum indicators like the MACD were flashing persistent sell signals, which really pointed to a change in character. And then, all eyes turned to NVIDIA's upcoming earnings. That became the key catalyst. Meanwhile, everyone was watching that key support for financials right around $51 for XLF.
And then came Friday. This was the session that mattered, where the fundamental news finally came in and confirmed the technical breakdown we'd been seeing.
The selling really picked up into the close, locking in the worst November in 17 years. You saw the Fear and Greed Index just plummet to 11. That's extreme fear. And the final nail in the coffin? The Fed's October minutes dropped. They showed that officials were not on board for a December rate cut. And just like that, the market-implied odds for a cut just collapsed.
Okay, so that's the day-by-day. Now let's zoom out a bit and look at the big themes that were really driving the action this week.
Really, the whole week was defined by this core tension, the classic bull versus bear fight. In the bearish corner, you had undeniable technical damage. The S&P breaking its 50-day, topping patterns forming in key sectors, it was all there. But in the bullish corner, you had some powerful contrarian signals. Sentiment was at extreme fear, hedge funds were way offside short, and history actually shows that the market is often up 6 months after a break like this. That's the battle that defined the week.
And this quote from Google CEO Sundar Pichai really just hits the nail on the head. It perfectly captures the concentration risk we're dealing with. It's all about the systemic risk from this AI narrative. With NVIDIA's earnings coming up, everyone knew that one company's report could literally move the entire market.
All right, let's talk volatility and key levels. How was all this uncertainty being priced, and what were the lines in the sand?
So you can see a pretty big gap here between implied and realized vol. IV, which is what the options market thinks is going to happen, was way higher than RV, what was actually happening. That tells you the options market was pricing in a big move. And that premium was all about one thing, the event risk from NVIDIA's earnings.
These are the levels we were watching all week. For the S&P, it was the break of the 50-day and the subsequent test of support. For financials, you had XLF and KRE both testing those key breakdown levels. And NVIDIA, it was just stuck in a range, with everyone watching that $180 level as major support ahead of the print. Those were the key battlegrounds.
Okay, last part. What's next? Let's look at the catalysts on the calendar for the week ahead.
Top of the list, no surprise, is the NVIDIA earnings report. That's going to dictate the direction for semis and probably the whole market. After that, we're listening to every word from Fed officials, looking for any change in tone. Then you've got non-farm payrolls, which is always a big volatility event.
And remember, some key October data is delayed until after the December Fed meeting, so that uncertainty isn't going away anytime soon.
So this all leads to the big question, right? You've got the S&P below its 50-day, but sentiment is at rock bottom. Is this just a consolidation before we head higher? Or is this the start of something worse, a deeper correction?
Just a reminder, this is all for educational purposes. We're aggregating public info to help you stay informed. You have to do your own research. This is not financial advice.
If this helped you out, go ahead and subscribe for future weekly recaps. And one last time, not trading advice, just a market recap. All markets carry risk, so manage your downside and always verify the data.